Good evening, students. Welcome to the session. So, today we are going to start a new topic, which is the taxation of the digital transactions. Okay. So, in the last lecture, we had completed charitable trust, right? And the political parties, all of that provision. In this particular class, we are having the dedicated topic today, which is going to be the taxation of the digital transaction. So that's a separate chapter which forms part of your module also. So we will be starting with that particular chapter. So let us start with that taxation of digital transactions. So what are we going to study in this particular chapter? We are going to see the e-commerce transactions. We are going to see the transfer of the taxation on the transfer of the virtual digital asset and how do we tax that, right? So first of all, let us understand. Okay, let me share the screen from the module itself. Let me know if this is visible.
Visible,
Yes?
ma'am.
Okay.
Visible.
So what is e-commerce transaction, students?
Online transactions जो भी करते हैं like Amazon, for
Online?
example,
Yes.
Amazon
Your
Amazon
voice
पे
is
सेल
not
कर
very audible.
like Amazon पे अभी जब सेल कर रहे हैं प्रोडक्ट्स तो वो
Right.
सब जो है ई कॉमर्स ट्रांजेक्शन्स वो सब क्या हो रहा है ऑन ऑनलाइन प्लेटफॉर्म.
Right. So e-commerce transactions is actually much bigger than what we see today. So it includes not only the buy sell of goods on Amazon, it also includes providing these services like today we are having Blinkit, we are having Zomato, Zepto, where you are able to place the orders on these apps and you get the food delivery right at your doorstep. It also includes your banking system, like financial intermediaries which are there through which you are able to make the payment of any product you're buying, any services you're availing, anything which is there, right? So Google Pay, Phone Pay, right? So Paytm, these are again the financial platforms which have been developed or the payment gateways which have been developed for making the payment, right? Again, this is part of the e-commerce transaction. Then if you look at the social media that we have, Instagram, Facebook, WhatsApp, again, this is nothing but the part of this e-commerce framework itself, right? Where again you are able to purchase the services, you are able to like buy the goods on Instagram also. So or even Facebook has its own marketplace. So you can publish your ads on Facebook, Instagram, and WhatsApp. So all of that has become part of the e-commerce transaction. It is not only restricted to what you do, the buy and sell through the Amazon, Flipkart, like that, right? So, and again, it includes many other things within its realm. So there are multiple things which are included in the e-commerce. And now, why is it so important to have a dedicated chapter on this particular e-commerce transaction? So if you look at the e-commerce transaction, that is very different from the brick and mortar businesses, right? In the brick and mortar businesses, you had a nexus with that business, that okay, this is how the income is arising in this country and you could tax it. But with e-commerce, the nexus norms have gone outdated. Like for example, we used to talk about the income accruing, arising, or income deemed to accrue or arise in India. Those things are not any more relevant in the context of e-commerce, because in e-commerce you are not actually, you may not be actually conducting the business in one country. You may be having the website in one country, and you may be just making the sale of goods in one country. You may be having website in one country, you may be providing services through that website, and the customer may just be located in another country. So the taxation norms have become outdated in the context of the digital economy, isn't it? So therefore, there is a need to have a segregated tax policy as to how do we first of all say that where is the income getting sourced, where is the transaction taking place, where is the activity taking place, or whether it is like being taking place at the place where, let's say, for example, at where the customer is located, where the place where the, payments are being done, where the website is being used. So it is not very clear. Secondly, the problem with respect to digital transaction arises in respect of how do you characterize the income, whether it is fees for technical service, whether it is royalty, whether it is business income. There is no particular layout given under the tax law, right? So in that regard, the OECD, which is there. So OECD stands for what? Any idea?
No, ma'am.
Nobody knows what is OECD? Yes. Organization for Economic Cooperation and Development. So I'll tell you a brief background. Like today, we have little bit time in our hand because this chapter is not very vast. So let me just, have a discussion with you. This will help you understand the basics of taxation and the international taxation where we are getting into, right? So understand, students, see, this entire framework, what you see with respect to the tax treaties, you know about what are tax treaties? Yes or no?
Between the two countries, there will be a tax treaties.
Yes, but what are these basically? Any idea?
मतलब आपके कंट्री में अगर कोई भी टैक्स इनकम होता है तो वहाँ पे टैक्स भर रहे हैं तो हम अपने कंट्री में टैक्स उतना नहीं भरवाते हैं ताकि डबल टैक्सेशन वो सब ना लगे एंड व्हाट परसेंटेजेस पे वो सब लगेगा वो सब.
Acha. See, if I have to tell you, like, after this World War One and Two, right? So after World War One and Two, what happened is there was, a lot of trade commerce which started back, right? And if you have studied some history, you would know that, these Western countries, West world was trying to dominate and create the colonies in the other regions like India, South Africa, Japan, right? All of these countries. So there it gave rise to dumping of goods from these West world into these particular countries, right? And it was also the case that after World War these European countries were also struggling, and US was also struggling, right? They started having this import export of goods. At that point in time, they felt a need that because of this import and export of goods taking place between the countries, they were having the problem of double taxation because every country is taxing it, the income from these transactions. So a country of residence where the company is incorporated, that will also tax the income on the basis of residency of that company. The country where the trade is taking place, that country will also tax it because the trade is taking place in that country or the manufacturing is taking place in that country. So this resulted in the problem of double taxation. So obviously, nobody would want to pay 50-60% of their income into taxes because that would hamper the trade and investment, isn't it? So the Organization for Economic Cooperation and Development, before that itself, like before OECD, there was this League of Nations, which is an organization. Okay, League of Nations was an organization. It's no more there. It has been converted into United Nations as we see it now. So the Organization for Economic Cooperation and Development, before that, the League of Nations had started with the work on finding out how we can remove this double taxation or how we can tackle these double taxation. So basically, the four economists were studying about it, right? The four economists were studying about like how can we allocate the taxing right between the two countries. You can take a simple example like students. Let's say, for example, if I have a place, right, a house, right? In that house, there is a garden. Now, उस garden में there is one tree of apple, right? Which has grown so much that it falls into my neighbor's house also. And my neighbor's children are able to, pluck that apples and eat it. But who has grown that apple? It is me. I have put the feed for that apple. I have been watering that apple tree. So technically, I should be taking the fruits of it. But now it is spreading over to the neighbor's house, right? So he's also enjoying the fruits of it. Now, both of us are fighting over like who should take the apples. So in international tax also, it is something like that only. Like my resident who is basically, staying here, using the infrastructure of my country, utilizing the resources of my country, labor of my country, roads of my country, is now moving into another country to earn the income. He is not technically changing his residency, but he is establishing his business in another country. So other country will also try to tax him. So both of them are fighting over like who would get what taxing right. So League of Nations was the organization which had started the study on how to allocate the taxing right between the two countries. Because if both the country tax at the full rate, obviously what would happen is there would be no incentive to do the trade and investment in the other jurisdiction. So every country cannot, produce on its own everything. We have to import something, we have to export something. We are good at something, the other country is good at something else. So therefore, they had started with that. And after League of Nations had published its report, then it was not, too successful at introducing any, recommendations under the international tax law. The OECD was the first organization of Organization of Economic Commerce and Development. So OECD was the first organization in a way which had basically started the work on international tax. We developed the tax model conventions. What are model conventions? Model conventions are nothing but basically it gives you the template as to how your tax treaties should look like. So as somebody rightly pointed out, that the tax treaties are nothing but, a mechanism to avoid the double tax between two countries. It's an agreement. Let's say I have an agreement with my neighbor that, okay, I'll take 10 apples, you will take 4 apples. Right? So the treaties are essentially the agreement between the two countries as to what taxing right each of them would get based on what they agree in the tax treaty. So it's an agreement. But the agreement template, which is there, like, you have the table A, you have the schedule 3, right, under the Companies Act. Now, is schedule 3 a template or is it like, a final thing? The final thing will be what your financials look like. The schedule 3 is merely a template. It gives you an idea how to structure your financials. Same goes with the OECD Model Convention. It gives you an idea as to how your actual treaty should look like, how you have to interpret the treaty. It's a model convention, it's a template that how you have to enter into tax treaties, the two countries, right? So the OECD was in fact the first organization to come up with its own model convention. Now, why I have been telling you this history is for you to understand the work that has happened on the digital transactions, on the e-commerce transactions. So you should know the history behind it, and then you would be fully able to appreciate this point. Right? So the OECD did a lot of work, but the OECD has a membership. Like our normal clubs have membership. Have you seen ever like, there are these, big fancy clubs where you have to pay 8 lakh, 10 lakh rupees to just get the membership. And there are some clubs, like in specifically in Bombay and Delhi, if you would observe, they would give entry only to rich people. Even when you are ready to pay their membership, they would not entertain you. OECD is something like that. OECD is you can call it as a club of rich countries, the developed countries. So when the OECD was formed, the membership of the OECD was with the rich countries. All the European countries, US are the members of OECD. The developing countries were never the members of OECD. So obviously the policies, the OECD model convention will always be based on whose favor? Developed countries. It never favored the developing countries. It never gave the taxing right to developing country. So it always retained the taxing rights with the developed countries. So let's say, for example, if we talk about a simple thing like business profits, the tax treaties which are based on the OECD model convention says that the business profits will be allowed to be taxed in the source country only when there is a permanent establishment in the source country. Permanent establishment, you can understand like something like, exactly your business connection under 911. And you will see all of these concepts in detail in the international tax class. So therefore, what will happen is the business profits can be taxed in the source country only when you have the business connection or the permanent establishment in source country. Now, permanent establishment means what? Having a fixed place to do the business in the other country. If the e-commerce companies now you see, do they have a fixed place of business in the source country? Yes or no?
No, ma'am.
No, right? They don't have a fixed place of business. They are not operating in brick and mortar business model. They have websites, they have servers, they have, sometimes, only the consumer being here. Sometimes the website is also of US. The servers are also located outside India. They may only have the customers here in India. Let's talk about the Instagram. Is Instagram having an Indian website? No. So then Instagram has a server in India. Answer is no. Is Instagram an Indian company? Like it is owned by Meta. Is Meta an Indian company? Answer is no. Now you may say that, ma'am, Instagram doesn't earn any income in India. Do you think it earns the income or it doesn't earn the income?
Excuse me, Prerna, are you sharing some screen? But it's not visible.
Ma'am, I've shared the module itself.
But it's been paused. The screen is paused.
Oh. Is it visible, ma'am, now?
Yeah, now it's visible.
Okay. So yes, students, what do you think? Whether Instagram is doing some charity for you or is it really monetizing the money? Yes.
It
You have
is
been spending a lot
monetizing
of
the
time
money,
on
ma'am.
Instagram. Yes.
It is monetizing the money, ma'am. There will be
How?
sponsored ads, and the sponsored ads will be there on Instagram.
Yes, that's very right.
So it
So
will,
yes. So all of these platforms that you see, Facebook, Instagram, WhatsApp, are not running for charity. They make huge money out of the data they collect from you. So when you say about these sponsored ads, right? What they do is they collect your data, they segregate it into different buckets depending on your age, gender, then location, preferences, and then they sell these data to advertisers. Now connecting to one book for one. Sorry, yes. So basically, if you look at it, they are selling your data for a huge sum of money to advertisers. And that's how they are monetizing. Even on WhatsApp these days, you would see that there are a lot of ads which come in. Right? So it's not a free platform. So all of this, if you look at it, there is how will I be able to tax this income of the Instagram? How should I tax it? Is it like having any permanent establishment in India? Answer is no. Instagram doesn't have any office in India. Right? Facebook does not have any office in India. So how should I tax its income? For example, if we talk about Google, when you put the results or when you search anything on Google, again, is it throwing you the results for free? The answer is no. Google is again making the money from the advertisements. They run Google ad program, Google AdWord program. So basically, when you go to certain websites, you would see that on the top of it or on the right and left side of it, there are banners. Yes or no? So Google is directing the ads towards you. Or when you search for something, You sometimes get these sponsored ads. Yes or no? So when you get these
Yes, ma'am.
sponsored ads, so then, for example, let me show you something. Let's say I went to this Google, right? And I want to see, let's say, Bata shoes. This is a sponsored result, right? This is a sponsored result. So this Bata is running ad over here. So that is how basically Google is making money. Now, does Google have a presence in India? It has. But does it have a PE in India? Answer is no. So how can I tax the business income of Google, Facebook, WhatsApp, Instagram? Right? Even in the case of, let's say, for example, if I may be, able to find some way to tax their income, how do I characterize the income? What is the characterization of this ad fee that they are collecting? Is it a royalty? Is it fees for technical services? Answer is no. Courts have time and again held that these are not royalty and fees for technical services. So then what is the bucket that I am left with? Business income. And business income can only be taxed in the source country only when there is a permanent establishment. So now you understand that how my tax laws have gone outdated with respect to the emerging technologies. Are you able to appreciate this? So, the tax laws have not been able to keep pace with the development in the technology because the tax laws still require physical presence for the taxability of the business income. So, the OECD itself did a rework on its tax laws that it had developed in the context of tax treaties. Right? Because, India was in fact the first country in 1990s when the computers had emerged in India. At that point in time, India had made a representation to OECD through a report published by CBDT that there is a need to change the definition of P and bring new tax laws to tax the e-commerce transaction. But the OECD did not listen to it. It said, no, this is capable of taxing it. And it did not change the definition of PE. Because again, OECD was trying to favor the developed countries. Right? Then in 2008, when the global crisis happened, at that point in time, OECD realized that even it is losing out its taxing right because of the development of e-commerce models. Because now they are no more manufacturing countries or the technology countries. They are also becoming the source country, and the only country which is a technology hub is US. So then they revisited their own policies and started with this BEPS project. What is a BEPS project? Any idea about it? Yes. So BEPS project was basically the base erosion and profit shifting project. So if you look at it, because of this rise in digital transactions, rise of digitalization, what is happening? The base of the source countries is getting eroded because the source countries where these companies are earning the income are not able to tax it. And the profits are getting shifted to other countries where the taxes are low. So that is basically the BEPS project which was started, base erosion and profit shifting project. And under that, there were different strategies which were leading to the BEPS were identified and the solutions were given for that. And one of the fundamental BEPS action plan was action plan 1 with respect to the tax challenges raised by the digitalization of the economy. So that is one of the fundamental challenge which was identified, which is giving rise to the BEPS. So OECD, along with the G20 nation, developed these action plans, 15 action plans. And the action plan 1 was dedicated towards this particular challenges arising from the digitalization. Wherein they identified what are the challenges. As I told you, the challenges were with respect to nexus. How do we tax? How do we link the income to a particular country? Whether where the consumer is located, whether where the transactions are taking place, whether where the payment is being made, whether where the website is located. How do we identify the nexus? How do we characterize that income? Whether it is royalty, FTS, business income, how do we characterize it? And even if we are able to do all of that, how do we tax the income? How do we attribute the income to a particular country? Based on where the data is collected, where the data is processed, where the data is sold, no answers. So these were the concerns identified in the BEPS Action Plan 1 report. And it gave 3 interim solutions. Why I'm saying interim solution is because in the BEPS Action Plan 1, final conclusion to tax this complicated problem. This is a very, very complicated issue. Right? This was a very complicated issue. How would you expect them to come up with some solution under BEPS Action Plan? So they gave some interim solution. What were the interim solution? Significant economic presence, withholding taxes, and an equalization level. So these were the 3 recommendations which were given in the BEPS Action Plan 1. So the first one is significant economic presence. So what they suggested is that where the companies are able to do the business with the particular country through a sustained economic interaction, not through the physical presence, but through a sustained economic interaction with that country, then that country has got some nexus to tax that income. Are you getting my point? Second, withholding taxes is nothing but your TDS on digital transaction, and an equalization levy can be implemented, which will equalize the impact resulting from the disparity between the foreign and the domestic businesses. So if a domestic business does a digital transaction, they will be taxed in India. When a foreign business does a digital transaction, we would not be able to tax it. Why? Because there is no permanent establishment in the source country. So there is a disparity which is happening in the tax treatment between the foreign and the domestic businesses. So to address that disparity, an equalization levy would be implemented. Are we getting it? And then it recommended several other options like modifying the definition of the P to provide for when an enterprise is engaged in digital activities. That would constitute the P if it has a significant digital presence in another country's economy. Or introducing the concept of virtual fixed place of business. So where an enterprise maintains a website on the server located in any jurisdiction and carries on the business through that website. So that will constitute the virtual fixed place of business. And they left all these options to the countries as however they or whichever option the countries want, they can introduce in their tax out of this. What India did? India adopted all of these three options into its domestic law. India adopted all of these options into its domestic law. So first of all, India was the first country to implement the equalization levy in 2016. See, the BEPS action plan came in 2015. Immediately in 2016, India introduced the equalization levy at the rate of 6% on the consideration received from the advertisement in India. And again in 2020, India introduced equalization levy at the rate of 2% on the e-commerce services. So India was the first country to introduce the equalization levy, and the other countries then started following India. It also introduced this significant economic presence concept in its tax law and also a withholding tax. But remember, all of these were interim measures till the time the final measures are given by the OECD. The countries can go ahead and introduce these. However, the equalization levy which was there, it was not introduced as a part of the Income Tax Act 1961 because the CBDT, before introducing this, had constituted a committee to study this levy. And the committee concluded that this levy is not an income tax. It is outside the scope of income tax. So this will not be introduced through the amendment in Income Tax Act, but this will be introduced through the Finance Act. Just like we have the STT, CTT, the same way we will introduce through the Finance Act the equalization levy. Now, obviously, when they introduced it through the Finance Act, it was not considered as an income tax. So, the companies were not able to take the credit of these taxes under the treaty because this was not income tax and the tax treaty applies only to the income taxes. So, this was obviously resulting in double taxation for the companies. And it was increasing the compliance burden for them. And it was introduced in 2016 and 2020, and we are today in 2025. When the OECD has made some progress over this particular area. And what had started happening was that when India introduced the equalization levy, Italy, France, Germany also started introducing this similar kind of levy. They called it as digital service tax. We called it as equalization levy. But when all the countries started introducing it, US, which is the hub of technology companies, started fearing that this would result in eating up of the US taxing rights. Because if every country will tax this income on the gross basis, that is, they would not allow the deduction of expense. And the US will not be able to give the credit of these equalization levy because these are not income tax. These are not introduced as income tax. So they are outside the scope of the tax treaties. So what will happen? US will have to share the taxing right with all the other countries. So when US was having that fear, US started threatening the other countries by imposing the tariffs and the sanctions. US threatened all the countries that if any country goes ahead and implements this equalization levy or digital service tax, we will put the tariffs and the sanctions on those countries. Now also you see how the tariffs are being imposed by US, right? That is all part of this. So then the country started taking back the equalization levy and digital service tax for the want of certainty, because that will, impact the trade and investment in the world. So therefore, in lieu of that, and as a promise given to the OECD, India took back the equalization levy in 2020-24 on first the e-commerce supply and services. And while Finance Act 2025, it also took back the equalization levy on the advertisement services. So now we do not have any equalization levy in place. Are we clear up till now? Any questions, any doubts so far?
Ma'am, right now it is one of the most इनकम बहुत ज़्यादा आता है ना मैम, तो इंडिया तो बहुत ज़्यादा लूज करेंगे ना मैम if it is taken
Agreed.
by.
Agreed. But see, the point is that, what is happening? If the countries are, allowed to go ahead with the equalization levy, the companies who are operating were not able to operate effectively because they had to bear a lot of charge on their gross revenue, because this was applicable 2% on the gross revenue or 6% on the revenue from advertisement, and no expenses were allowed. So this was impacting a lot of certainty. And then US was, threatening with sanctions. They also imposed the sanction tariffs on different countries, which raised the cost of trade and investment altogether. Right now, also, if you see, the cost of trade and investment is very high because of US imposing tariffs. So to achieve that certainty, India had agreed to lose taxing right, because obviously, if India continues with equalization levy, it would lose out on the imports that it is making from the US. Because if US start imposing the sanctions, the goods will become expensive for us. Then the domestic economy will also suffer. So that is, tax is one part of the political discussions which happen. So it is always a compromise that, nation has to make in want of the certainty with respect to the investments and the trade which are being carried out. Any other question? Yes.
No, no ma'am.
Okay. So this was with respect to the equalization levy. That's it. Earlier, till the last attempt, we had a lot of discussion on the equalization levy, but since now it has been abolished, so there is no more further, portion which is covered in your syllabus. But just to give you an update, what is happening at the OECD level? At the OECD level, still we do not have a final solution. These were interim solutions. After that, OECD continued to study for the last 10 years after 2015, but was not able to arrive at any solution because of no support from US. Whatever solution it is bringing, the US is opposing it because US is not in a favor of sharing its taxing right with any other market countries. However, OECD has developed a solution called as Pillar 1, which provides for a new taxing right, a new amount on which the tax has to be paid. But that is still not finalized because none of the countries have been able to agree to it because of the US objecting it in a very full force. So again, at this point in time, there is no solution to tax the digital transactions. So this is where we stand as on today. Fine. So let us move up to the next part of the chapter, which is taxation of the virtual digital assets. Now, what are virtual digital assets? Any idea? Yes.
Cryptocurrencies.
Cryptocurrencies
NFTs.
are, yes, are one such form of the virtual digital asset. But how 247A defines virtual digital asset is, it means any information, code, number, or token not being the Indian currency or foreign currency. So it doesn't include the Indian currency or foreign currency. So any information or code or number or token generated through the cryptographic means, providing a digital representation of value exchanged with or without consideration, with a promise or representation of having inherent value, functions as a store of value or a unit of account, including its use in any financial transaction or investment, but not limited to investment scheme, and can be transferred, stored, or traded electronically. So, the virtual digital asset basically means it includes the cryptos, right? It includes the cryptographic transactions. So, how does these cryptos work? Any idea? Yes,
It is called blockchain technology through
correct.
this.
Very good. So, crypto transactions work through the blockchain technology. These are, like you may say that these are, like money itself. But these are the transactions which appear like, holding the value of unit. So if you look at the definition over here also, it says functions as a store of value, provides a digital representation of value exchange, and has some inherent value. But how it functions is basically they work on the blockchain technology entirely. So a Bitcoins, for example, blockchain will start at your cryptocurrency wallet. So first a transaction is entered into, then it is transmitted to a network of the computers scattered across the world. It runs into, some equations. And once the originator, the miner, confirms it to be legitimate, they are then created into the blocks. And they have some unique code. So, cryptographic transactions which are there, these are basically again a new set of evolving technology which have emerged. So, these had to be again tackled in a different way. So therefore, this particular definition was introduced to tax this. Now, if you look at it, also includes a non-fungible token or any token of the similar nature by whatever name called. Any idea what are the non-fungible tokens? Yes, have you
These are
read
like
about it?
yeah, these are like digital drawings, paintings, or many other things converted
Right,
digitally and sold and purchased digitally.
right. So, as you rightly mentioned, these non-fungible tokens, again, you would have read about, uh, people buying land on the space. You would have read about people, creating the patents for their own drawings, own sketches. So there were many news articles about it, right? People are buying houses using the NFT. So there are different things which are happening through the NFC. So NFCs, but what are they exactly? So basically what is happening is the, let's say, original painting of Mona Lisa is there, right? You have an original painting of Mona Lisa. Now, what you can do is you can create a unique and one of a kind code for it. So it is basically non-fungible. So NFT is like a digital certificate of you owning the Mona Lisa painting. Or, a dematerialized share certificate. Earlier, we used to have the share certificates in physical format. Now we have the demat share certificate, dematerialized shares. So think of NFT as a digital share certificate or a sale deed of land in a digital form. It is not an asset. It is a proof of ownership of that asset. And that proof is recorded in a ledger that is not possible to tamper with. Are we getting this? So what is the difference between the cryptos and the NFTs? Cryptos are fungible. So let's say, for example, if I have 100 rupees, if you and I exchange 100 rupees note, we both still have 100 rupees because they are interchangeable and they are identical. So I have Bitcoin, you have Bitcoin, we can exchange it. However, if I have painting of Mona Lisa, can I exchange it with you? They are not same. You don't have that. So that is non-fungible. I have a land. Can I swap it with your land? I will be able to do so, but both are not same. That is non-fungible. So non-fungible token is a unique digital certificate that gives you the ownership over some asset, digital art, a video clip, or even a physical item. So, for example, in the real world, we maintain the ledgers and the journals, right? For the audit trail. There's an audit trail which you create. When you see the ledgers journal, there's an audit trail and you cannot alter with it, right? For example, Tally has this new feature of audit trail. Yes or no? Same way, the blockchain is a decentralized public ledger. Now, instead of you holding the Tally file, thousands of people around the world hold identical encrypted copies of the NFTs. So when an NFT is created, the transaction is recorded as a block of data and this is added to the chain of all the transactions. So now because everyone has a copy of it, there's a huge copy in the line of data which is there. So there's a copy in the huge line of data which is there. So because everyone can see that copy, right? Can a hacker edit it? The answer is no. For a hacker to edit it, he will have to edit on all the computers. So this makes the NFT a very certified digital source of their ownership. So you can trace the ownership of the NFT back to its original creator and no one can tamper with that history. Are we getting it? So this is classified as a virtual digital asset. So what are the virtual digital assets? One is the crypto transactions and second is the NFT. Again, as I said in the crypto transaction, you have the wallets, like you have your GPay, PhonePe, Paytm wallet. In crypto also you have the wallet. Now it has certain keys, like you would have a key to your locker in the home. This also has a key. It has two keys. One is the public key, which is basically what you share it to others. Let's say, for example, if I want to give you my GPay number, it will be, let's say, my number @ OK ICAI, @ OK Kotak, @ OK HDFC. Like your bank account or UPI ID. That's a public key. That you share it with the others to receive the funds. And anyone can see it and it's perfectly okay to share. That's your wallet address. Then there is a private key. What is my private key? In the UPI, in my GPay, what is my private key? The PIN that I entered, which is my secret password. That prove that I am owning the funds associated in that wallet. Right? That is my OTP, my net banking password. So when you have your wallet, you can create a transaction message, which will be basically, let's say when I want to transfer the Bitcoin from my wallet, I would say, I, the owner of this public key A, whatever my public key will be, the address of my wallet, authorize the transfer of 1 Bitcoin to this another wallet of another person who has given me its wallet. Just like in my GPay, I authorize GPay to transfer money from my HDFC bank account to, let's say, you. And I authorize it how? By putting my PIN or OTP. And then the wallet broadcasts this request to the entire crypto network. And then what will happen is, there are miners of crypto who mines the cryptos, who mines the Bitcoins. The miner basically creates this particular Bitcoins or the cryptos. And what they do is, when they want to transfer from one person to, when you want to transfer from you to somebody else, the miner will pick up any Bitcoin and will transfer the Bitcoin to another person. It is working like a bank, which will validate that, okay, you are transferring to another person, and will add it to the blockchain. How miner will add? They will solve some mathematical puzzle or a formula, write the code, and will add the transaction to the block. And that's how the chain gets formed. So that is how the crypto transactions basically work. So that is the definition of virtual digital asset under 247A. Right? So the central government-wide notification of 2022 has specified a token which qualifies to be a virtual digital asset as NFT. It shall not include an NFT whose transfer results in ownership of underlying tangible asset, and the transfer of ownership of underlying tangible asset is legally enforceable. So basically they have said that where the actual asset, underlying asset gets transferred because of transfer of NFT, that is not included in the crypto asset. Or any crypto asset being, so it also includes any crypto asset being a digital representation of value that relies on the cryptographically secure distributed ledger or a similar technology to validate and secure transactions, whether or not such asset is included in ABC point above. And the central government has excluded certain things from the virtual digital asset, which is the gift card or vouchers. You get the credit card points, you get the reward points, you get the credit card vouchers that are not virtual digital asset. Mileage points on airlines, reward points, loyalty card, again that are not the crypto transactions or virtual digital asset. Subscription to websites or platforms or application, again that is not virtual digital asset. So how the income from the virtual digital asset will be taxed? It will be taxable under section 115 BBH at the rate of 30% on the gross basis. No deduction will be allowed in respect of any expenditure. You will of course get the deduction of the cost of acquisition, but you will not get deduction of any other expenditure. For example, your expenditure on the transaction charges, bank charges, you will not get any deduction. You will also not get any set-off of loss against any other income. So loss from the transfer of virtual digital asset will not be allowed to be set off against income under either this provision or any other provision. And virtual digital asset need not be a capital asset. It can be stock in trade, it can be capital asset. Is this clear? Any questions so far? Yes?
Clear, ma'am.
Clear?
Clear, ma'am.
Then they say, in order to tax the virtual digital asset also in the hands of recipient, if the FMV of the virtual digital asset exceeds 50,000 and it is received without any consideration, then it will be taxable under 56(2)(10). Or if it is received for inadequate consideration, then the difference between the FMV and the consideration as it exceeds 50,000 would be taxed under 56(2)(10). However, if the virtual digital assets are given as a gift to the relative, then of course 56(2)(10) doesn't apply. So all the exclusions of 56(2)(10) will also be applicable to virtual digital assets. Plus, there is a TDS on the payment on transfer of virtual digital asset under 194S. So 194S requires any person who is responsible to pay to any resident by way of a consideration for transfer of virtual digital asset to deduct the TDS at the rate of 1% of such sum. It will be deducted at the time of credit or payment, whichever is earlier. Right? What if the consideration for transfer is wholly in kind? Let's say I'm transferring 1 Bitcoin for Ethereum. Or it is partly in cash, partly in kind. Then how will you deduct the TDS? Because I'm not paying you technically any consideration in cash. So then they say that the person responsible for paying the consideration has to ensure that the tax has been paid on the equivalent amount of consideration before releasing the consideration in kind. And they say that the TDS will not be applicable where in case of a person where the consideration is payable by a person being an individual or HUF whose total sales, gross receipts or turnover from the business does not exceed 1 crore in the case of business or 50 lakh in the case of profession in the preceding financial year. And the threshold is less than equal to 50,000 for the consideration. And in case of any other person other than this individual or HUF, the threshold has been kept at 10,000. Once the TDS has been deducted, it has to be deposited within 30 days from the end of the month of deduction. And in case of March, it will be 30th April. I will have to deposit to the government. In any other case, 7 days from the date of the. Then you have to also furnish, the payer has to furnish the statement in form 26QE and it has to be done within 30 days from the end of the month of deduction. So payment to the government within 30 days, form 26QE within 30 days from the end of the month of deduction. This is in case of a specified person. Specified person means whom? The one who is individual or HUF whose sales are less than 1 crore in case of business or 50 lakh in case of profession in the preceding financial year. For all others, the due date remain the same, which is 7 from the end of the month, and they have to furnish from 26QF for the exchanges, and for any other person, it is 26Q. And they have to file as per the due dates for the 26Q, which are normally there. For quarter ending June by 31st July, for quarter ending September by 31st October, and for quarter ending December, Jan, and then March 31st May. Clear? Any questions? Yes?
Clear, ma'am.
Okay. Now, CBDT has issued certain guidelines in respect of the applicability of 194S. So what are these? Let us try and understand. They have raised it in the FAQ format. They are saying who is required to deduct the TDS when the virtual digital asset is taking place, when the transfer is taking place through the exchange. So, there are these exchanges which are there where you can trade in the cryptos. So, payment is made by the purchaser to the exchange, either directly or through the broker. And from the exchange, it goes to the seller or through the broker. So then who is required to deduct TDS? It is not happening one-to-one. It is not peer-to-peer transaction. It is happening through an exchange in between. So 194S says any person who is responsible for paying to any resident has to deduct the TDS. In case of peer-to-peer transaction between buyer to seller, the buyer The payer is required to deduct the TDS. However, in the case of exchange being there, how will I deduct it? So what they say is that when there is transfer taking place to an exchange, then the 194S will apply at multiple stages. And to remove the difficulty, because when the buyer sells to the exchange, seller sells to the exchange, there will be the TDS on the exchange. When exchange gives it to the buyer has to deduct the TDS with respect to exchange. So to avoid that, what they are saying is, in case where the transfer takes place through the exchange and the VDA is being owned by a person other than exchange doesn't own it. So the buyer would be crediting or making the payment to the exchange, and the exchange would be then making the payment to the seller. So tax may be deducted either only by the exchange, which is making the payment to the seller. Right? So in case the virtual digital asset is with the broker, then it is the broker who is seller. Then if the broker pays to the seller, again it will have to deduct the TDS. And in case where the credit or exchange is between the exchange and the seller through a broker, and the broker is not seller, broker is also holding on behalf of seller, then the responsibility shall be on both the exchange and the broker. However, if there is a written agreement between the exchange and the broker that broker shall be deducting the tax, then the broker may only deduct it. Right? Secondly, they are saying in a case where the transfer of VDA takes place through an exchange and the VDA is owned by exchange. In the first case, VDA was not owned by exchange. Here, the VDA is owned by the exchange. So again here, the buyer is required to deduct the TDS under 194S. But buyer may not know whether the VDA is owned by seller or whether it is owned by exchange. So what they have given is, they have said that only the exchange will be required to deduct the TDS. So although the primary responsibility to deduct the TDS is on the buyer or his broker, however, the exchange may enter into a written agreement with the buyer that the exchange would be paying the tax in respect of this. And it would be furnishing all these Form 26 QF also. Second question is, so question number 1 was with respect to the transactions where the consideration is not in kind. How will this operate in a situation where it is in kind, where one Bitcoin is exchanged for another, or one Bitcoin is settled for Ethereum? So where A is being exchanged with another virtual digital asset B, where both the buyer and the seller are buyer and seller. So one is buyer for Bitcoin A, another is seller for Bitcoin A. One is buyer for Bitcoin B, another is seller for Bitcoin B. Does both need to deduct the TDS? Yes or no? So these are the practical challenges. However, if the transaction is taking place through the exchange, then in order to remove that practical difficulty, the TDS may be deducted by the exchange if there is a written agreement in place. So exchange would be required to deduct the TDS for both the legs of the transaction, and the buyer and seller would not be independently required to follow it. And it has to ensure that the tax withheld in kind, the tax shall be withheld in kind. The tax shall be withheld in Bitcoin only, will be then converted into INR and deposited with the government. Are we clear? Then they say whether the provision of 194Q is applicable on transfer of virtual digital asset. So if 194S is applicable, 194Q will not be. Then they say whether the consideration shall be on gross basis after including the GST or commission, or it will be on net basis. So the CBDT has clarified that it will be on the net consideration, not including the GST or the charges. Then the second question they have answered is that in case where the payment is being carried out through payment gateways, then let's say for example, if I am purchasing a virtual digital asset, now I make the payment through a payment gateway, let's say Paytm. So payment gateway is also required to deduct TDS. I may be also required, exchange may be also required to deduct the TDS. I may be also required to deduct TDS. So what they have said is, so let's say for example, if I am required to make the payment to seller, whether I will deduct or the payment gateway will deduct. So payment gateway will not be required to deduct the TDS if the tax has been deducted by me as a buyer. But there should be a written agreement in place. Clear? So these are some of the FAQs which have been given by the CDD. Let us understand through a question. Compute the net income tax payable of Mr. Abhinav, who has the following income. Interest on fixed deposit 1,10,000. Interest on saving bank 35,000. Consideration for transfer of EDA 4,62,000. Cost of acquisition 21 and expenses on transfer 1,000. And Mr. Abhinav has exercised the option to shift out of 115 BAC. What will happen? Yes.
Ma'am, here total income is less than 2.5 lakhs, basic exemption limit.
Correct.
Right, ma'am? So for
Yes.
the fixed deposits and saving bank accounts, there will be no tax.
Correct.
But for virtual digital asset, it will be taxed at 30%. For
Correct.
4,62,000 minus the cost of acquisition 21,000.
Correct. There's right. Fine. Then next question is income from salary is given for Siddhant is 24 years. Interest on saving bank is given 12,000. Consideration for the transfer of VDA to Mr. Harsh 50,000 and the cost of acquisition is 5,000. Harsh is employed with ABC on a monthly salary of 50. In addition, he has interest on saving bank with Bank of India. Mr. Siddhant has not exercised the option to shift out of 115 BAC, ignore TDS on income other than VDA.
Income from salaries, since it is computed, we don't have to remove 75,000 standard deduction. 840
Yeah.
plus 12,000, it will be taxed at normal slab rates as per 115 BAC. Then for virtual digital assets, 50,000 minus 5,000 will be taxed at 30%.
Correct. And Mr. Harsh, since he does not have PGBP income and his total consideration for the VDA does not exceed 50,000, he need not deduct TDS under 194S on the consideration payable to Siddhant. Right? Clear?
Okay, ma'am.
Fine.
मैम यहाँ
Yes.
पे हर्ष वो जो सिद्धार्थ को ट्रांसफर करेगा, बीच में एक्सचेंज रहता है कि नहीं रहता, वो कैसे पता चलेगा?
See, यहाँ पे नहीं दिया है, so you will assume that there is no exchange and it is a peer-to-peer transaction.
Okay.
Any other question?
No, ma'am.
Yes. Let us solve one more question from the module. From the following details, compute the income of Mr. Mohan for sale and purchase of Bitcoin and NFT. They have purchased a Bitcoin June 15th. They have sold the Bitcoin. And then again they have sold on July 20th. Expenses incurred they have given. On August 1, they have purchased the NFT, sold NFTs in 2 tranches. And the expenses are incurred on the sale of NFT. So first we'll talk about Bitcoin. So if you look at it on July 15th and July 20th, they have sold 2 Bitcoins, right? So first we'll talk about sale of Bitcoin of 15th July. So sale consideration will be my 25,500. What will be my cost of purchase? 2,500 into 50,000 divided by 5,000, right? Secondly, for the sale of Bitcoin, again 28,750 will be my sale consideration and 25,000 will be my cost of acquisition. This will give me the gain right? 500 in the first case and 3750 in the second case. Next, I have purchased the NFT. I have sold 6,000 NFT worth 89,000. So my cost of acquisition will be what? 1,50,000 divided by 10,000, which gives me how much? 1,500 into 6,000. Yes, that will give me 90,000. So I will get a loss. Now, can I set off this loss against the gain of the cryptos?
No, ma'am. Losses cannot be set off.
Correct. Losses cannot be set off. In the last case, I have sold it for 56,000 and my cost of acquisition will be 4,000 into 1,500, which gives us 60,000. So can I set off this loss from the again NFT against the crypto gain? Answer is no. So even in the case of sale of loss of one crypto, loss of one VDA, I cannot set off against the gain of another VDA. Are we clear?
Yes, ma'am.
Okay, so we'll stop here. We'll take a break and then we will start with the TDS chapter. Let's take a break of 15-20 minutes. Ashok ji? Yeah. another topic, which is TDS. Let us
I
start
have
with
a
it.
I have a doubt. I have a doubt on
Yeah.
illustration 2.
Okay, sure.
Yeah, I think there should be a rebate under section 87A also. I don't know if I'm wrong or right.
One second, my PC got hacked. In illustration 2, as in the examples that we did, right?
Yes.
One second, let me open it. Sorry. This one, right? You're asking?
Yes.
But here you are saying that the rebate should be there in this
Yes.
case. So, what are the limits for the rebate under 87A?
So 12 lakhs is under in Finance Finance Act 2025. It was increased to 12 lakhs, I think.
Correct. So, here, what is the tax income which is coming to 8 lakh 97 thousand? 8 lakh 97,000 is the total income, right? And
Yes.
what they have said is that the income shall be 12 lakh with effect from 1st April 2026. So for AY 26-27, yes, you are right. Here there should be a rebate which should be there. Yes, I agree there should be a rebate in this particular case. But one second, let me just reshare the screen with respect to what we had done for the rebate there. We go back to the basic concepts class. Yeah. So if you recollect, I had told you that if the total income is less than equal to 12 lakh, then yes, there should be the tax or rupees 60,000, whichever is lower should be given as the rebate. However, rebate is not available. It cannot exceed the income under section 115 BAC and also not available on the income chargeable at special rate. So for the other income, which is not chargeable at special rate, you will be entitled to rebate. So I think there is a mistake in the module, I think. Yes, you're right. Fine.
Okay, fine. Thank you.
Yeah. So now let us move to the next topic. Which is TDS, TCS, advanced tax. Let me just open up the module. Let me just prepare the notes here itself. Okay, so first we'll start with the TDS on the salary. Okay, so first of all, tell me one thing in respect of TDS under salary, which is the section
192.
192. 192 is the section for the TDS, right? So who is the payer in respect of that?
Employer.
Employer, right? Now the question arises here in respect of the payer, right? So whether the employer is only a person who is a resident in India or will it also include a non-resident? One second, sorry. Yeah. Whether the employer is a person resident in India or whether it will also include a non-resident. So for that, let us refer to section 192. Let us go back to the income tax section. Salary. What does it say? Any person responsible for paying any income chargeable under the head salary. So what does it refer to? It refers to any person, students. Any person means that the employer can be a resident as well as a non-resident. Right? So here you have to write it. Payer includes resident plus non-resident. So my employer can be any person, includes a resident or a non-resident. Income chargeable under the head salary shall at the time of payment deduct the income tax payable at the average rate of income tax computed on the basis of rates in force for the financial year in which the payment is made on the estimated income of the assessee under this head for that financial year. So here they have not given that only 192 is applicable only when the payee is resident. So payee can also be a resident plus non-resident. So if let's say for example a foreign company is making a payment to a non-resident in respect of the salaries, in respect of employment exercised by that non-resident person in India, the foreign company will have to deduct the TDS under section 192. Are we clear? Yes or no? What
Yes,
will
but
be my rate of deduction? What will be my TDS rate? Average rate of tax at the rates in force. Where do I get the rates in force?
Finance Act.
Finance Act. Part 2. Yes, in the part 2, I will get the rates to the act. Clear? In the schedule 1, part 2, I will get the current rates of tax for this particular financial year. What will be the timing?
Monthly.
Yes, monthly, but at the time when the payment is made. Right? So the tax has to be deducted when I am making the payment of the salary. So at the time of the payment, the deduction has to be at the time of the payment. Clear? Now understand here one thing. How will the employee intimate as to what is the regime that he is opting for? So how will the employer know? Yeah, declaration.
They will take
Correct.
declaration from the employer.
Correct. So what does the section say here is that it has to be at the rates in force. So the employee needs to take the declarations from the employer needs to take the declaration from the employee with respect to the income that the employee is having. So 192 casts the responsibility on the person who is responsible to pay. So if you look at section 192(2)(d), it says the person responsible for making the payment referred to in subsection 1 shall, for the purpose of estimating the income of the assessee or computing the TDS under 1, obtain from the assessee the evidence or proof or particulars of the prescribed claims, including the claim for set-off of loss under the provisions of the Act in the manner as may be prescribed. So basically what they are trying to say is that the employer has the responsibility to collect the proofs. So the employee have to file the declaration in form 12BB. That declaration is applicable for all the claims that they make. For example, if they want to claim the HRA, if they want to claim the leave travel concession, if they want to claim the deduction of interest under the house property, they have to intimate the employer. At the same time, if they want to opt out of 115 BAC, they have to exercise in that. Are we clear? So if you look at in your module also, it says for HRA, these are the evidence: name, address, PAN of the landlord where the aggregate rent exceeds 1 lakh. For leave travel concession, evidence of the expenditure. For the deduction from income from house property interest, name, address and PAN of the lender. For any deduction under chapter 6A, they have to give the evidence of the investment or the expenditure. So the assessing of, the employer has the responsibility to take these particular proofs. Are we clear? So 192(2)D casts the responsibility on the employer. Yes or no? Any question?
Clear, ma'am.
Fine. So this is for the purpose of estimating the income. Now, secondly, in terms of the 192, right? So the income tax ideally will be deducted, or the TDS will be deducted in respect of the tax rates provided under the default tax regime 115 BAC 1A if the employer does not, if the employee does not give the declaration of opting out. So 115 BAC is the default tax regime. If the employee wants to opt out, he may exercise an option by giving the form 12BB. So the employer has to ask the intended tax regime. If the employee does not give, then in that case, it will be as per the default tax regime. And once you have exercised a regime, if you have not given a declaration, you have not opted out, or if you have opted out, you cannot change again and again. For the purpose of the TDS. Yes, but you can always change it when you are filing your tax return. So it doesn't mean that when you exercise, let's say, old regime, or when you go as per the default tax regime, it doesn't mean that you can't change in the return. You can always change it into the return. Are we clear?
Yes, ma'am.
Okay. Next is 190 to 1A. It says that the person without prejudice to the provision of 1, the person responsible for paying any sum in the nature of perquisite, which is not provided for by way of monetary payment. What does this mean? A non-monetary perquisite. So if an employer gave a non-monetary perquisite, what are the examples of non-monetary perquisite?
ESOPs.
ESOPs, or like rent-free accommodation. Correct? So then how does the employer pay the TDS? So employer may pay at his option the tax on the part of the whole or the part of the income without making any deduction the time when the tax was otherwise deductible under the provisions of subsection 1. So basically what does it say is that the employer which is there, when it makes the payment of the non-monetary consideration, so employer may pay this tax at his own option in lieu of deduction of TDS. So instead of deducting the TDS, the employer itself may pay the tax. So it is not possible to deduct the TDS from a non-monetary perquisite. So in that case, he can pay directly instead of deducting from the salary. And in case of an eligible startup who issues the ESOPs, in case of an eligible startup referred into ICAI, which is registered with the DPIIT and fulfills all those conditions, the employer, if it gives the ESOPs, it has an option to pay or deduct the income tax within 14 days after the expiry of 48 months from the end of relevant assessment year, or from the date of sale of specified security or the sweat equity share by the assessee, or from the date of assessee ceasing to be the employee, whichever is early. So usually on the sale of on the grant of ESOPs, the ESOPs are treated as the perquisite when the option is exercised by the employee. When the ESOPs are exercised by the employee. right? So obviously in that particular case, when will the TDS be deducted? TDS will be deducted in the year in which the employee exercises the option. But in case of a startup, since their shares will take long time to gain that value, they have been given an extended time. So there the employer can deduct the TDS or pay the income tax within 14 days or 48th month from the expiry of the relevant assessment year, or when the employee actually sells the ESOP, or from the date when the employee ceases to be the employee of the assessee. Clear? Yes, any question, any doubt?
Clear.
Yeah. So this is about the salary which is there. Right? So this is about the TDS on the salary. So 192 provides the deduction of the TDS in the case of both resident as well as non-resident. Right? So the payee can also be resident, the payer can also be the resident or non-resident. Secondly, there is 192.1b, which has been there. Now, 192.1b provides what? It says for the purpose of the 192.1a, the tax shall be determined at the average rate of tax on the basis of the financial year on the income chargeable under the head salary. And the tax so paid will be construed as if it's a tax payable at the source. Now, additionally, avoid these cash flow issues. Right? To avoid the cash flow issues for the employee, the scope of 192.1b has been extended to include any tax deducted or collected at source, allowing it to be taken into account. Right? Allowing it to be taken into account for the purpose of making the deduction under 192. Now, what does this mean? So, let's say for example, I am the employer. I will deduct TDS on all your income if you declare me all the income. Yes or no?
Yes.
Yes, ma'am.
Right? Now, it is quite a possibility that on my, let's say, interest income, there is already a TDS deducted by the bank. On my, let's say, rental income, there is already a TDS deducted by my tenant. Now, if you also deduct the TDS or if I report you the income, what will happen? There will be blockage of my cash flow. Yes or no? So what the 192 provides is, 192 says that the employee can inform the employer not only the incomes that it has earned, but it can also inform the employer that if the taxes are deducted or collected under any other provision of the Act. And if there is also a loss under the head income from house property, if he is opting out of 115 BAC, then he can report that as well. Right? So, in that case, the employer will deduct the TDS on salary at the lesser rate. Are we clear? Yes or no?
यस मैम. मैम ऐसे तो अच्छा डिक्लेयर ही मत करो ना अगर वहाँ पे भी TDS कट हो रहा है.
See, what happens is the TDS sometimes is deducted in respect of rent at the rate of 10%, in respect of interest at the rate of 10%, right? Now, what happens is that अब वहां पर आपका 10% पे हुआ है, but it is quite possibility that your salary is taxed at 30%. Now, what will happen when you will file your income tax return? So you are already in 30% slab, but interest और इस पे तो आपका 10% पे ही deduct हुआ है. So balance shortfall of 20%. On that, you will end up paying the 234B, 234C interest. Are we clear? Any questions? Yes? So if you do not declare, then you will end up paying 234B, 234C interest. So it is better to declare it. Clear? Yes? So if you read 2B, it says when an assessee who receives any income chargeable under the head salary has in addition any other income chargeable under any other head of income, not being a loss under the other than the loss under the head house property. So you can't claim the loss from business, loss from capital gains, all of that with respect to your TDS while calculating TDS on salary. Any tax deducted or collected as the case may be for the same financial year, he may send to the person responsible for making the payment the particulars of income, tax deducted, loss from the income from house property. Clear? Any questions? Is 192 clear to everyone? Yes?
Yes,
Fine.
clear.
Okay. Now, next section is 192(2)(a). Sorry, 192(a). Payment of accumulated balance due to an employee. So what does it say? That the trustees of the EPF or any other person who is like an employer who is making the payment of accumulated balance of due to the employees. Right? When the accumulated balance due to an employee who is participating in a recognized provident fund, when this balance is taxable, then at the time of the accumulated balance, deduct the income tax at the rate of 10%. However, this will be applicable where the payment is more than 50,000 to the employee. Are we clear? So basically what happens is, under the Employee Provident Fund Act which is there, the payments when the employers pay to the employee, when this payment is taxable in the hands of the employee, they will have to deduct at the rate of 10%. So when is this taxable? So usually the withdrawal of the balance from the recognized provident fund is exempt from tax under Part A, 4th Schedule to Income Tax Act, under the Rule 8. However, if the employee has not served a continuous service of 5 years and does not transfer his PF balance from one employer to another, in that case, the withdrawal of the PF is taxable in the hands of employer. So, Rule 10 of Part A of 4th Schedule requires the trustees of the RPF or the employer to deduct the TDS on the amount withdrawn by treating that the contribution which was made by the employer was a contribution not to the recognized fund but to the unrecognized provident fund. Because if you withdraw from the unrecognized provident fund, it is taxable. So what is the rate of TDS? 10% at the time of payment. So if you withdraw the funds within the period of 5 years, then in that particular case, 192A applies. Shall we write it down? Payer is again the trustees of the EPF or the employer. Payee is your employee. Here you can write before 5 years of continuous service. Then in that particular case, the TDS is 10%. Timing at the time of payment and the threshold is 50,000. Clear?
मैम आफ्टर 5 years के बाद में अगर निकालते हैं तो वो एग्जाम कौन से सेक्शन के नीचे?
Exempt. That is exempt under the rule which is there in the 8 of the part A of 4th schedule to the income tax.
ओके
Yeah?
ओके मैम.
Yes. Okay. Next section is 193. Interest on securities. What does it say? The person responsible for paying to a resident any income by way of interest on securities shall, at the time of credit to the account of the payee or at the time of payment in cash by check, draft, or any other mode, whichever is earlier, deduct the income tax at the rates in force on the amount of interest payable, being the amount or the aggregate of amount exceeding 10,000 rupees during the financial year. So, here under 193, who's my payer? Any person? Whether they are given any limit of 10 lakh, 50 lakh, no. Here they have not given any limit of the payer who has to have a turnover limit of any kind. They have not given anything. Okay. Then, who is the payee? Resident. Payee is my resident. TDS is 10%. Timing is payment or credit, whichever is earlier. Then, what is my threshold here? 10,000. Then no tax shall be deducted from interest payable on these national defense bond, interest payable to an individual on national defense loan or these different national defense loan are given, national development bonds, NSC certificates, interest payable on debentures issued by any institution or any public sector company or a cooperative society, interest payable on gold bonds, interest payable on the government securities. Then they say that nothing contained in this section shall apply to the interest exceeding 10,000 rupees on the 8% saving taxable bonds or these saving bonds which are there. So again, the limit is given for 10,000. Interest payable to an individual or HUF who is a resident in India on any debenture issued by a company in which the public are substantially interested, if the amount of interest does not exceed 10,000 and such interest is paid by the company by an account paycheck. Interest payable to the LIC, interest payable to the GIC in respect of securities owned by them, interest payable by any other insurer, interest payable to a business trust in respect of any securities via special purpose vehicle. Do you recollect this particular point? Yes or no?
Yes, ma'am.
Yes. So, in all these cases, there will not be any TDS. Clear? So, that is section 193. Let us move further. Then we have 194. TDS on dividends. 194 says the principal officer of an Indian company or a company which has made the prescribed arrangements for the declaration and payment of dividend within India. Which is this company?
फॉरेन कंपनी वो डोमेस्टिक कंपनी को.
Correct. Very good. So, this is a domestic company. A company which has made the prescribed arrangements for the declaration of dividend within India is nothing but a domestic company. Are we clear? So the domestic company is required to deduct the TDS in respect of the interest which is, dividend which has been paid. Clear? So a domestic company is covered over here when it makes the dividend shall before making any payment in respect of dividend or before making distribution or payment to shareholder who is a resident in India of any dividend within 222A, B, C, D, E, F. Deduct from the amount of such dividend income tax at the rate of 10%. No such deduction shall be made by in respect of a shareholder being an individual if the dividend is paid by any mode other than cash and the dividend does not exceed 10,000 rupees. Clear? So let us write it here. This is my 194 TDS on dividend. Payer is the company, or I can write here domestic company. Pay is resident. Threshold is 10,000. TDS is 10%. Timing is payment or distribution. Clear? However, they say that this section shall not apply to any income credited or paid to LIC, GIC, any other insurer, business trust by a special purpose vehicle. Again, do you remember this? Yes or no?
Yes, ma'am.
Okay. So, in these cases, the dividend will not be liable to TDS. Then, one more important point here. There is a notification issued here in respect of 194. What does it say? No deduction of tax at source under 194 on dividend paid by an unit of an IFSC which is engaged in the business of leasing of an aircraft to a company being a unit of an IFSC primarily engaged in the business of leasing of aircraft. So the central government has issued a notification that tax is not required to be deducted under 194 from dividend paid by any unit of IFSC which is engaged in the leasing of an aircraft to any other company which is also a unit of IFSC engaged in the leasing of aircraft. Subject to the following, that the payee will furnish a statement cum declaration to the payer giving the details of the previous year in which the dividend income is eligible for exemption under this section 1034B, and the payer would then not be required to deduct the TDS in respect of this. Are we clear? Yes? Any questions, any doubt? Yes or no, students?
मैम
Yes.
डिविडेंड अगर कैश में दे रहे हैं तो वी हैव टू डिडक्ट टीडीएस इवन फ्रॉम 1 rupee, राइट मैम?
Correct. That's right.
Okay.
Any other question? Yes. Is this clear?
Clear, ma'am.
Okay. So this is just a notification which is given. You may not remember, but that is fine. Okay. Now there is one more case law that I want to cover before we move on to the interest on securities. So let me open up that. That is in respect of salaries that I want to cover. Okay. The Supreme Court case in the case of ITC Limited. The question before the Supreme Court was whether tips received by the hotel company from its customers who made the payment through credit card and distributed to the employees would fall within the meaning of salaries to attract a deduction under 192. See, we go to restaurants. When we eat, when you are done, you may just give a tip. Now, you may give a tip to the hotel itself to give it to the waiters. So when the hotel will distribute it to the employee, can it be called as a salary for the purpose of deduction of TDS under 192? That was the question before the Supreme Court. So is it a salary according to you?
नो मैम, बिकॉज देर इज नो राइट नहीं रहेगा ना मैम, एम्प्लॉय अगर नहीं मिला तो केस या कोई राइट्स नहीं है मैम, बोल
Correct.
It is not contractual payment.
It is not
कॉन्ट्रैक्ट
contractual.
कॉन्ट्रैक्चुअल यस.
Correct. So here the employee which is there doesn't hold any right over the company. Right? So here also this is not given under the employer-employee relationship. This is given to the hotel in a fiduciary capacity. So section 15, which is in respect of salary, applies when an employee has a vested right to claim any salary from the employer or former employer. Here there is no vested right on the part of employee to claim any amount of tips from the employer. These are purely the voluntary payments. So amount of tips paid by the employer has no reference to the contract of employment. These are given in a fiduciary capacity as a trustee to the hotel by the customers, which are then given to the employees. So therefore, this could not be regarded as a profits in lieu of salary in terms of section 17(3), and the payment will not be liable as a with respect to the TDS under 192. So here the tips are being paid by the customer and not by the employer. So even though the amounts were held by the employer, he had no title to the money and it was held in a fiduciary capacity, and therefore the court held that 192 will not be applicable. Clear? One more case with respect to 194A. In case of UCO Bank, it is a Delhi High Court case. The question before the UCO Bank was, before the Delhi High Court was, is section 194 applicable in respect of interest on fixed deposits in the name of Registrar General of High Court? So, what had happened that when you go for a case, you have to deposit certain amount, right, in the fixed deposit till the case gets decided. And that fixed deposit is kept in the name of the Registrar General, and whosoever wins the case will be getting that amount. Now, when the interest is paid on that fixed deposit, whether the TDS is applicable under 194A, that is question, because the deposits are kept in the name of Registrar General. So here the court analyzed that the expression payee would mean the recipient of income whose account is maintained by the person paying the interest. The Registrar General is holding again the amount in the fiduciary capacity. He is not the recipient of income, nor the interest is accruing to him. Therefore, he cannot be considered as a payee for the purposes of 194A. And therefore, the banks will not be required to deduct the TDS in respect of the payments made to the Registrar General till the matter is decided by the court. Once the court decides the ownership of the money lying in the fixed deposit, then only the 194A will be applicable. And the CBDT has also accepted this by way of a circular in 2015. Clear? Fine? Yes or no? Any question?
मैम, अगर केस है जिसको आगे वाले जीता है, सपोज है जिसने केस डाला है वो जीता है, तो इंटरेस्ट अमाउंट उसके ऊपर आए, इंटरेस्ट का इनकम उसके पास जाएगा, तो 194A के नीचे कब काटेंगे क्या मैम?
जब वो केस जीते, मतलब जिसके नाम पे केस एफडी अमाउंट जाएगा उनके नाम पे फिर टीडीएस डिडक्ट होगा.
ओके मैम, तो मतलब पूरा इनकम एट ए टाइम एक ही साल में ऐड होगा.
करेक्ट. Correct. Okay. Let us move back now to the 194A. Interest other than interest on security. 193 was interest on security. This is 194A, which is interest other than interest on security. Now here it says any person not being an individual or HUF, right, who is responsible for paying to a resident any income by way of interest other than income by way of interest on securities. So who is the payer over here? Any person or the individual or the HUF. For individual or HUF, the condition is whose total sales, gross receipts or turnover from business or profession exceed 1 crore in case of business or 50 lakh in the case of profession during the financial year immediately preceding the financial year in which the interest is paid. So if you're looking at for this year to deduct the TDS, which is previous year 25-26, you have to see the turnover of individual or HUF for the previous year 24-25, whether it exceeded 1 crore or 50 lakh. All right. Then, who is the payee? Payee is my resident. What is my timing? Whichever is earlier. Fine.
Is it applicable on the persons who declare the income under section 44 AD and ADA also? This 1 crore and 50 lakhs?
No. It is not dependent on that.
So if their
It is
income is more than 1 crores or 50 lakhs, it is applicable.
Yes.
Okay.
What does it say? That the provisions of subsection 1 shall not apply where the amount, as the case may be, or the aggregate of amount of income credited or paid or likely to be credited or paid during the financial year does not exceed 50,000 rupees where the payer is a banking company, 50,000 rupees where the payer is a cooperative bank, or 50,000 rupees in the case of the post office saving bank account scheme. Post office, which is there, deposit with the post office, or 10,000 rupees in any other case. So basically, what they have said is that here the TDS on interest will not be applicable in respect of these particular thresholds which have been given. So here they have given a multiple level of threshold. Okay, they have given the multiple thresholds over here. So what are the thresholds? 50,000 rupees. If the payer is a bank, my threshold is 50,000. For a cooperative society or a cooperative bank, as we may call it, again 50,000. Post office, again 50,000. And for others, it is 10,000. Provided that in respect of the income credited or paid in respect of time deposits with a banking company to which the Banking Regulation Act applies, or time deposits with a cooperative bank, or deposits with a public company which is formed and registered in India with the main object on carrying on of the business of providing long-term finance for construction or purchase of residential houses and which is eligible for reduction under 36(1)(a), the aforesaid amount shall be computed with reference to the income credited or paid by a branch of banking company or the cooperative society or the public company as the case may be. Now, what does this mean? Yes. Can you infer the meaning of this? Yes, can you infer the meaning of this? Yes, very simple. No? Let me explain. What does this mean is that when you compute these particular limits or threshold in respect of the fixed deposits which are there with the bank, cooperative bank, or deposits with any public sector company which is engaged in the long-term finance for residential house. You have to compute these thresholds not with respect to the consolidated bank, with respect to each branch of bank. Let's say I may be holding a fixed deposit with ICICI Bank Mumbai branch, then one with ICICI Bank Pune branch. So this 50,000 limit is not applicable for ICICI Bank together. It is for each branch. Are we getting this point? Yes or no? And what they say is that where the amount which is referred to this limits which are given, where the bank or the cooperative society or the public company has adopted the core banking facility. When it has adopted the core banking facility, what is a core banking facility?
CBS.
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 So CBS is basically like they have integrated operations. That is a core banking facility. Right? Under the core banking facility, what happens is that the consolidated results appear is a centralized system into a single database where the customers can access the services from any location. So it is like all the multiple branches of the same bank are integrated into one. So where the banks have the core banking facility, in that case, we will not go as per the branch level, we will go as per the bank level. So that's what they are trying to say. Are we understanding this? Yes or no?
Yes, ma'am.
Fine. Then what they are again trying to say here is that in respect of the senior citizen, in respect of the payee being a senior citizen, instead of 50,000, the words 1 lakh had been substituted. Are we getting? So for a senior citizen, the threshold here which is there, the threshold is rupees 1 lakh. Clear? Any question, any doubt till now? Yes or no? Okay.
Clear.
Then they say that the TDS will under 194A will not be applicable for any income credited or paid to a banking company. So if interest is paid to another bank, you don't need to deduct the TDS. So when you pay the interest on loan from a bank, taken from a bank, do you deduct the TDS? Answer is no. Because in that case, this exclusion applies. Or when the TDS, when the interest is paid to any cooperative bank. So when the income is paid to when the interest is paid to a cooperative bank, again there will not be any TDS. However, here they say again, if any income is paid by a cooperative society, if any income is paid, interest income is paid by a cooperative society, which is not a cooperative bank, to any member, where the interest is paid by a cooperative society, not being a cooperative bank, to any member or in respect of the income paid by one cooperative society to another cooperative society, there also the TDS will not be applicable. So when a cooperative society makes a payment of interest to the members, or when one cooperative society pays to another cooperative society, in that particular case, the TDS will not be applicable. Are we clear? So you can write it here. TDS not applicable if interest paid to the cooperative bank society other than bank to its members or other cooperative society. Then also says here that income which is credited or paid in respect of deposits with a primary agricultural cooperative society or a primary credit society or a cooperative land mortgage bank or a cooperative land development bank. So any interest which is paid in respect of deposits with these cooperative society, there will not be any TDS. Or any interest paid on deposits other than the time deposits. What do we mean by time deposits?
Fixed deposits.
Fixed deposits. So any interest paid on the deposits which is other than the fixed deposits, meaning interest paid on saving deposits with a cooperative society other than the cooperative bank will not be subject to TDS. So what does it imply? Therefore, what is subject to TDS? Interest paid on the fixed deposits with a cooperative society or interest paid on the deposits with a cooperative bank will still be subject to TDS. Are we getting this point? So you can write here interest paid on deposits, savings you can write with cooperative society other than the bank. So TDS therefore will be applicable in the case when the interest is paid on the time deposit. So where interest is paid on the time deposits or interest on deposits with cooperative bank, this will be subject to the TDS. Are we clear?
Yes, ma'am.
So if one cooperative bank pays interest to the member cooperative society, let's say if the cooperative bank pays interest to a member cooperative society, whether TDS applies? You can read the section here once again.
Yes, applicable.
Why?
It's a bank, cooperative
Yes.
bank, not a cooperative society. Other than bank, yes. Only other than
Yes.
banks is not applicable.
Correct. So here the TDS will be applicable. Okay. So TDS, yes. Because here they say cooperative society other than the bank to its members. Okay. Fine. Yes or no? Is
Yes,
this
ma'am.
clear, student? Yes.
Yes.
Now, what else is excluded to such income credited or paid to any financial corporation? life insurance, unit trust of India, any company or cooperative society engaged in the business of insurance, or any other institution which may be notified. Then interest paid by a firm to a partner of the firm. Again, that is not subject to TDS under 194A. Then interest paid in respect of deposits under the scheme framed by central government. Then interest paid by the central government under the provisions of this act. Again, there is no 194A. Interest on the compensation awarded by the Motor Accidents Claim Tribunal, or interest on the compensation amount awarded by the Motor Accidents Claim Tribunal where the amount of such income does not exceed rupees 50,000, or interest paid by an infrastructure capital company or infrastructure capital fund, debt fund, public sector company, scheduled bank in relation to a zero coupon bond, and interest referred to in 1023 FC. What was 1023 FC?
Pass-through entity, special purpose vehicle.
Yes, when the SPV pays to the business trust.
Business trust.
Yeah. Then in respect of a cooperative society, they say that in respect of this, interest credited by a cooperative society to a member, or in respect of the interest paid in respect of deposits with a cooperative society other than the cooperative bank. What they say is that a cooperative society shall be liable to deduct the income tax if the total sales, gross receipts or turnover of the cooperative society exceed rupees 50 crore in the previous financial year, or the interest exceeds rupees 1 lakh for a senior citizen or 50,000 in any other case. So basically what they are trying to say over here is that the TDS will be applicable in this case. So in these two cases, TDS applicable if turnover of cooperative society exceeds how much? 50 crores. In preceding financial year, and interest is greater than rupees 50,000 or 1 lakh for senior citizens. Is this clear? Yes or no? Yes,
Clear.
is this clear? Okay,
Clear.
fine. You can also write here, if interest paid to the partner by the firm. Fine. Now we look into certain aspects from the module in this regard. There have been certain circulars. One of this we already looked into, that in case the deposits are kept in the name of the Registrar General, then until the case has been decided, banks are not required to deduct the TDS. This one we already saw, the circular given by the CBDT also. Then second is no deduction of the TDS under 194A on payment made to a member of the scheduled tribe by a scheduled bank. In this case, there will not be any TDS. Third is deduction of TDS on interest income accrued to minor child where both the parents have deceased. So what does the provision say? The rules say that the Director General, what they will do is, they will, in the case of minor where both the parents have deceased, TDS on the interest income accruing to the minor in respect of any deposits, right, will be deducted and reported against the PAN of the minor itself, unless a declaration is filed by some other person that the TDS should be given to the guardian. Clear? Next is deduction of TDS on interest on deposits made under the capital gain account scheme, where the depositor has deceased. What is a capital gain account scheme?
सेक्शन 54 के नीचे कैपिटल गेन्स के अंदर डिडक्शन क्लेम करने के लिए करते हैं.
Correct. So if you have not yet invested in the specified asset, you can put the amount in capital gain account scheme. But where the depositor has deceased and the interest is accruing, so the TDS should be deducted in whose name? So the TDS up till the date of up to the period of the death of depositor is required to be deducted and reported against the PAN of the depositor. After that, it will be deposited against the PAN of the legal heir. Are we clear? Any questions, any doubt till now?
मैम अभी हाउसिंग फाइनेंस से लोन लेते हैं ना मैम, विच इज नॉट डायरेक्टली ए बैंक, तो उनको जब पेमेंट करते हैं तब टीडीएस डिडक्ट करना कंपलसरी है क्या मैम?
See, here they have given that any financial corporation which is established either under this particular central state or provisional act, उनके ऊपर नहीं आएगा. But if it is other than that, then yes, there will be the TDS liability.
Okay.
Or there are some notified institution. If it's a notified institution, then in that case, it will not apply.
Okay.
Right?
Okay.
Okay. Then next one is 194B, winning from lottery or the crossword puzzle. They say the person responsible for paying to any sum, any income by way of winning from any lottery or crossword puzzle or card game or any other game of any sort, or from the gambling or betting of any form, being the amount in respect of a single transaction exceeding 10,000 rupees, shall at the time of payment thereof deduct the income tax at the rates in force.
मैम
Yeah.
स्क्रीन दिख रहा नहीं था, अभी दिख गया.
दिख रहा? Okay. So, where the amount is paid in respect of the gambling, betting, any crossword puzzle or any lottery amount, where in respect of a single transaction, the amount is paid more than 10,000. In that case, they have brought the deduction under 194B, which is how much is the rate given? At the rates in force. What are the rates in force? This will be as per the section 115 BPJ. So, what is the tax rate there?
30%.
30%. Correct. So, when the amounts are paid in respect of any game of lottery, winnings from crossword puzzle, card game, any sort of gambling, it shall be, TDS shall be at the rate of 30%. However, the amount has to be more than 10,000 in a single transaction. Okay. And in case where the winnings are wholly in cash, wholly in kind or partly in cash and partly in kind, so how will you deduct it? So the person responsible for paying before releasing the winnings in kind has to ensure that the tax has been paid. Are we clear? Fine. So we can write it over here. 194B. TDS on winnings from right? What is my TDS rate? 30%. Who is the deductor? Any person. Who is the payee? Again, any person. What is the threshold? Okay. Yes, simple section. Fine. Next is 194BA. Winning from the online gaming. They say, notwithstanding anything contained in any other provision, any person responsible for paying to any sum, any income by way of winning from an online game. Okay. During the financial year shall deduct the income tax on the net winnings in his user account computed in the manner as may be prescribed at the end of the financial year at the rates in force. Now, what are the rates in force over here? Yes.
30%.
30%. So again, in respect of this particular section 194BA, here again they have given the rates in force, which is 30%. Now here what they say that the TDS has to be on the net winnings in the user account. So what do we mean by the net winnings? And also if you read the second part, it says provided the case where there is a withdrawal from the user account. The income tax shall be deducted at the time of withdrawal on the net winnings in such withdrawal, as well as on the remaining amount of net winnings in the user account computed in the manner as may be prescribed at the end of the financial year. So basically they are saying that the TDS will be on the withdrawal of the user account, from the user account. Now how do we do this? So they have given a manner of computation. The CBDT has given a notification. Let us look at the module. This is the notification. So rule 133 has been notified, which prescribes a manner for the computation of net winnings. How do we compute? Net winning will be A plus D minus B plus C. What is my A? A is the amount withdrawn from the user account during the financial year. D is the closing balance of the user account. B is the amount of non-taxable deposit made in the user account by the assessee. And C is the opening balance of the user account at the beginning of the financial year. Now, what does this mean? So, let us say, for example, let us write this. So, deductor again can be any person. Deductee is also my any person. TDS is 30%. And what is my timing of TDS? On the withdrawal. Okay. Now let's say, for example, here, this is my wallet or my user account. Okay. Through which I'm playing the games. Let's say my opening balance is 0. Let's say there is a deposit in my wallet. I have put some money in my wallet which amounts to rupees 5,000. Now, what is the non-taxable here referred to non-taxable deposit made in the user account? They have given the meaning of what is a non-taxable deposit. I think, yeah. Amount deposited by the user in his user account and which is not taxable. So what is a taxable deposit? Any amount deposited in the user account which is not a non-taxable deposit includes the amount paid directly to the user, not through the user account. Which means, there are certain games that people play, like Dream 11 is one of the game which has been played online. What happens is they credit certain amount to your account as a free amount so that you can play the game to incentivize the users. That is a taxable deposit. What you deposit, what you put in your wallet, that is a non-taxable deposit. So here in my case, the amount that I have deposited in wallet is nothing but a non-taxable deposit, which is in my case B. And let's say I have winnings. I have won certain amount. Let us assume this is 3,000. And my closing balance is 8,000. And I have withdrawn, let's say 8,000. So this is my A, this is my B, and this opening balance is my C. So my net winnings will be A plus C minus B plus D. What is A? 8,000. Plus C, 0. Minus B, 5,000. Plus D, sorry, closing balance is 0 because I have withdrawn the entire amount. So 3,000 is my net winning. Are we clear? Yes or no? If I play a second game, let's say I play a second game also, and there is a deposit in my wallet of, let's say, 10,000. And I win, let's say, 6,000. Okay. So then I will do total from all the winnings. My 15,000 will be winning, which will, deposit, which is 15,000. Net winning is, winnings is 9,000, which makes it to 24,000. So this 24,000 will be my net winnings, total winnings, right? Which is 6,000 plus 3,000. But what the rules say here is, let us read it. Computation of net winnings at the end of the financial year. So my A will be the aggregate amount withdrawn from the user account during the financial year. B would be the aggregate amount of non-taxable deposit made in the user account by the financial. C is my opening balance, D is the closing balance, and E is the net winning comprised in the earlier withdrawal, which has already been taxed. So now what I have to do is I have to take this A as the aggregate amount withdrawn. What is my aggregate amount withdrawn now?
24K.
So 24K, correct? This 15, which is the total deposited plus total wallet balance that I, total winnings that I have. So I will do 24,000 A, correct? Minus, I will do A minus B plus C plus D plus E, right? Sorry, A plus D minus B plus C plus E. So what is my D here? D is the closing balance. Closing balance is 0. So I'm only taking 24,000. B is how much? 15,000. C is how much? 0. And E is what? E is my net winnings, which is how much?
3,000.
3,000. So this will give me how much? 6,000. Clear? Yes or no?
Yes, ma'am.
Okay. Let's say, for example, if I have two user accounts. Let's take another instance. I have two user account. One, user account 2. Let's say my opening balance is nil. Let's say deposit is 5,000. Let's say winnings are, here I made a 3K profit. Here I made a 2K loss. And let's say my closing balance is 8K here and 3K here. So total withdrawal is 11K. So what will be my net winning? 11K, my withdrawal. I don't have closing balance, so 0. Minus, what is my deposits? 10K plus opening 0. So total net winning comes to how much? 1K. Are we clear with this?
Yes, ma'am.
Okay. So here if you look at, they say user account shall include all the accounts of the user. Right? And where I have multiple user account, each user account shall be considered for the purpose of calculating the net winning and the deposits. And where there are multiple user accounts, if there is a transfer from one wallet to another, maintained with the same online intermediary, that shall not be considered as withdrawal or deposit. And where there is a payment in cash and kind, both, or cash, partly in kind, then in that particular case, I will have to, the payer has to ensure to pay the TDS before releasing the money in kind. Are we clear? Then
Yes, ma'am.
they say where the taxable deposit is in the form of bonus. So wherever there's a taxable deposit in the form of some bonus given, incentives given, promotional money given, and such deposit can only be used for playing the online games and not for withdrawal or any other purpose, then that shall not be considered for the purpose of calculating the amount B or C or D. What was my B? B was my basically, yes, B was my basically what?
Deposit.
Correct. Non-taxable deposit. So B is my basically non-taxable deposit. So it will not be considered for B, or it will not be considered for opening balance, or it will not be considered for the amount which is there in the closing balance, because that cannot be withdrawn. Fine. Then they have given certain FAQs again by way of a circular. There are multiple wallets under one user. How net winning is to be computed with respect to multiple wallets. So that we understood. So each wallet qualifies as a user account, which shall be considered for the purpose of computing the net winning. So even if there are multiple wallets, you have to consider each user account for the purpose of calculating the net winnings. And you have to consider then the aggregate of that. But if you are transferring from one wallet to another, that will not be considered deposit or withdrawal. Clear? Yes or no?
Yes, ma'am.
Okay. Then next is, if a user borrows some money and deposit in his user account, will it be considered as taxable deposit or non-taxable deposit? So for a non-taxable deposit, it is necessary that the amount deposited is not taxable. In a case where the user borrows the money and deposit, it shall be still considered as a non-taxable deposit. Clear? So because it is not something that has been credited to you. So that will not be considered as a taxable deposit. It will be still non-taxable deposit. Are we clear? Then how will the bonus referral be treated? So any deposit in the form of bonus would form part of the net winnings and would be liable for TDS at the time of withdrawal. However, some deposit could be like coins, coupon, vouchers. In such a case, the deposit shall be considered as a taxable deposit and form part of the balance in the user account. However, if it cannot be withdrawn, as I said, in that case, it has to be ignored. Clear? What point we consider the amount as withdrawn? When the user transfers the money from the user account to his own account. That shall be considered as the withdrawal. Then there are large number of gamers who play very insignificant amount. So they have given a concession that in these cases, tax will not be deducted where the net winning does not exceed 100 in a month. Tax not deducted on account of this concession is deducted at the time when the net winning exceeds 100. So in that particular case, TDS will not be deducted if the winnings are less than rupees 100. Clear? Yes or no? Yes,
And
yes.
what is the second part?
Second part as in?
Second clause.
Sorry, I didn't get it. This one, right?
Yes.
Yeah, so they're saying that if the net winnings are less than 100, you are not required to deduct TDS, but you will deduct it when the winnings will exceed 100 at the time of withdrawal. So basically, if the winnings are less than 100, you are not required to deduct TDS.
Okay. Okay.
Okay. Then how will the valuation of winnings in kind be required to carry out? So they say that if the online gaming intermediary has purchased the winnings before providing it, it will be the cost of purchase. Where he has manufactured it, then in that case, it will be the price which will be chargeable to customers as the value for such winning. So that is how the valuation will be carried out, and GST will not be included for the purpose of valuation. Fine. So this is the section 194BA. The last section that we have for today is 194BB, which is winning from racehorse. So winning from racehorse, any person being a bookmaker or a person to whom license has been granted by the government under the law for the time being in force for racehorsing, or for arranging for wagering or betting in any race course, who is responsible for paying to any person any income by way of winning from any racehorse, being the amount in respect of a single transaction exceeding 10,000, shall deduct the income tax at the rates in force. What are the rates in force?
30%.
30%. So you can write down 194BB, winnings from race horses. Who is my deductor? Bookmaker or who arranges the race horse. Horse racing. Deductee, any person. TDS, 30%. Threshold, 10K for single transaction. Clear? And timing is at the time of payment. Fine? Okay. So with this, we'll close for today. We'll continue in the next class with the rest of the section. Thank you so much.
Thank you, ma'am.
Thank you.
Thank you.
Ashok ji? Yes. Thank you. Good night.